For decades, managing personal finance meant standing in lines, filling out paper slips, and operating entirely on the bank's schedule. You adapted your life to fit the system, not the other way around. When those institutions invested your deposits, the capital flowed predictably into the heavy industrial engines of the 20th century, massive, carbon-intensive infrastructure over which you had zero say. Then a rapid sequence of global shocks hit. A pandemic halted daily routines, rising inflation squeezed household budgets, and climate anxiety reached a critical threshold. These disruptions highlighted a mismatch. The friction inherent in physical banking became a visible bottleneck for households attempting to manage assets in a volatile, digital-first environment. Individuals began moving their deposits toward platforms that offered immediate access and specific transparency. This transition, born of necessity, is now scaling into a broad redirection of capital across the global landscape. The financial landscape of 2026 is being built around three specific, non-negotiable human demands: the need for speed, strict ethical alignment, and uncompromised security. This line graph tracks annual digital payment volume in the US over recent years. You can see how the trajectory spikes upward, projected to cross the $10 trillion mark by 2026. Breaking down that total volume, the majority comes directly from mobile wallets and QR codes. Consumers are bypassing physical cards to take advantage of the immediate transaction speeds built into their smartphones. To support this surge in tap-and-go behavior, financial institutions deployed complex machine learning algorithms that operate constantly in the background. They analyze thousands of data points per millisecond to identify and block fraudulent transactions before they ever complete. Because the risk is mitigated invisibly on the back end, merchants are adopting these digital networks rapidly. They benefit from significantly lower transaction fees and the ability to settle accounts instantly, rather than waiting days for paper funds to clear. Extreme transactional convenience is no longer an optional perk for a business. It is the mandatory baseline for participating in modern commerce. Meanwhile, capital markets are experiencing a massive influx of funds directed specifically at clean energy, with U.S. investments projected to exceed $1 trillion in 2026 alone. This surge originates from a demographic tipping point. Right now, 3/4 of millennial and Gen Z investors actively withhold their money from companies that conflict with their personal sustainability standards. The federal government has amplified this grassroots pressure. Legislation like the Inflation Reduction Act pumps financial incentives into renewable energy projects, reducing the cost for businesses transitioning to green technology. Caught between individual investors demanding ethical practices and governments offering massive clean energy subsidies, major corporations are overhauling their operational models to comply with environmental, social, and governance standards. The result is physical infrastructure. Entire supply chains have been rebuilt, leading to highly automated battery manufacturing facilities and aggressive expansions of electric vehicle networks. Wall Street institutions are pursuing clean technology because the financial returns have proven to be reliable. Sustainability is now treated as one of the most stable, lucrative long-term strategies in the market. The economic shock of the pandemic shifted American financial priorities. By 2026, personal savings rates have remained elevated as consumers prioritize an active, defensive approach to their cash reserves. Instead of treating savings as an afterthought, households now prioritize building a liquid emergency fund that covers 3 to 6 months of living expenses. Take a look at this comparative bar chart. While traditional bank savings rates lose purchasing power to inflation, consumers actively migrate their cash to high-yield digital accounts that track and match rising inflation rates. To reach these higher thresholds without constant manual tracking, people are using robo-advisors. These automated platforms continuously optimize deposit allocations, allowing users to build security without needing a finance degree. By keeping their cash mobile and high-yielding, modern consumers have turned their savings from a passive storage bin into an active defense system against economic volatility. Digital payments, ethical investing, and automated savings have converged to create a financial ecosystem that is personalized to the individual. We have moved past the days of generalized banking products. Today, wealth management is continuous, frictionless, and optimized for the specific user's lifestyle. If you leave your money on autopilot in legacy institutions with low yields and high fees, you are accepting the degradation of your purchasing power. Success in this environment requires active control of your financial stack, utilizing modern platforms to ensure your capital moves and grows as fast as the economy around it. By deliberately routing dollars toward companies that match their ethics and accounts that protect their security, individual consumers are now the primary force dictating the direction of the global economy.